And Sam, you've already confirmed the confirmation of the quorum. Has the press been notified?
Yes, the press has been notified.
Good. And in the packet that we sent out, there is the meetings, minutes of the meeting from the Finance Committee held on May 27th. So I will entertain a motion, or actually, I'll entertain any questions first, and then a motion to approve.
So moved. It's Will.
Do we have a second?
Second.
All those in favor?
Aye.
All those opposed, like sign? Motion passes. So with that, Tracy, you got the floor.
Thank you, Mr. Chairman. Good afternoon, everyone. As we've done in previous meetings, I'm just going to walk you through a couple of schedules here that highlight our mortgage and servicing activity over the last fiscal year. And then I will turn it over to Brad Shelley, our partner at Crow, who will review our audited financial statements. I just want to make a note that those of you who are newer to the committee, we have to have our audited financial statements submitted to Ginnie Mae, Fannie, and Freddie by the end of this month, which is why the Finance Committee comes together and signs off on those. And then they will be presented to the full board at the October meeting. So that's why there's always a little sense of urgency at the end of September to pull this meeting together. But we'll start here on this, what we call the black and red chart. This chart reflects total outstanding bonds in black compared to total servicing portfolio in red. So as you can see, from about 2009 to middle of 2023, the total outstanding bonds continued to decrease to about 155 million outstanding, while our servicing portfolio continued to grow. As we've made the transition lately to issuing bonds again to finance mortgages, you can see the black line increase, where we now have a total of 663 million in bonds outstanding. It's just a really good way to look back on how we finance mortgages and continue to grow our loan portfolio. I'll cover a little bit more about the portfolio on the next slide, but I just want to note that we ended the fiscal year with a total portfolio of almost 3.6 billion, just shy of 30,000 loans. We finally hit 30,000 loans this month. Does anybody have any questions on that chart? So we'll move on to the next page. You might need to increase this a little bit, Sam, if you can. Thanks. So our plan to finance mortgages for the fiscal year was to issue bonds as well as offer our TBA secondary market program. The next few tables are the results of that financing plan. So starting at A in the top left, this just provides some detail on our bond issuances over the fiscal year. We issued a total of 270 million in bonds. 150 million of that was tax exempt and 120 million was taxable. These issuances occurred in October, January, and May. In 2026 is shaping up to look like a pretty similar schedule. Going down to letter B, this is the loan volume associated with those bond proceeds. So in fiscal 2025, we financed a total of 304 million in loan volume with mortgage revenue bonds. So we had a pretty healthy year using those bond proceeds. Going down to letter C, this is our Ginnies. This is our secondary market trading and gains on the next couple letters here. So our Ginnies, we had an overall loan volume of 214 million with an overall net gain. So that's after we paid lender compensation of 3.2 million. Again, as we've mentioned in several meetings, the gains continue to not be quite as robust as it was in years back, but it's still profitable. And then go down to letter D, Fannie Mae. We had a total loan volume of 31 million in fiscal 25 with a net gain of 218,000. Pricing was certainly more favorable in fiscal 24 compared to 25. Again, I think fiscal 26 is going to look pretty similar to fiscal 25 for what we've seen the last 2 months. And then lastly, on this page, letter F is our Freddie Mac. This is our product we introduced back in the spring of 2024. we had a total loan volume of 43 million and a net gain of 464,000. So to summarize it all, if you could scroll to the next page, Sam. So up at the top there, letter F, our total mortgage production from the secondary market was 288 million. With that and our mortgage revenue bonds, we ended the year around 590 million, which is pretty good given the housing supply issues we have and the interest rates we're seeing. So are there any questions on our mortgage financing activity? Okay. I'll just go over a couple servicing metrics here. Go back, Sam. Yes, right there. Yep. So looking at letter G there, as mentioned before, we've got a total servicing portfolio now of about 3.6 billion at June 30. This consists of 2.8 million in service for others, 166 million in our old indenture, and 529 million in our new indenture, and then 68 million either warehoused or in our HAF, our Housing Assistance Fund. You can see there that the old indenture continues to shrink and the new indenture continues to grow from our recent bond issuances. And then going down to letter H there, this is our weighted average servicing fee by loan type. I'll point out two here, our service for others. The service for other servicing fee is at 32.2 basis points, a nice increase by 0.4 over last year, which certainly, as you saw in the budget presentation at the last board meeting, had a nice impact on the bottom line with our increase in servicing income. And then going down to our new indenture, that SFMRB indenture, we have a servicing fee of 36.4 basis points at June 30 compared to 39.2 last year. This is a little more open to fluctuation. We'll continue to watch it. But at the end of the day, we can only take 1.125% spread between what we're paying the bondholders and what the interest rate is for our borrowers. So we generally have to change our rate on the MRBs to kind of follow where the bond yield is. So this is open to a little bit more fluctuation. But still, we're still making more than enough to cover the cost of servicing, overhead, and then some. And then going down to letter I, this is our delinquency ratio statistics. At fiscal year end, we had a good delinquency ratio of 4.62, slightly down from last year at this time. And then our foreclosure ratio is under 1% at 0.97. Again, we continue to watch that number, just given the economy and the impact inflation has on our borrowers. And then at the very bottom, I just kind of outline a financing plan for fiscal 26. We're monitoring potential refunding opportunities in the old indenture over the next 6 months. And then loan fundings though the secondary market program continues to generate profit, we've determined that issuing bonds will provide additional funding to help augment that program. We have a $75 million tax exempt and taxable bond issuance. It's actually going to be in the market Monday. As our private activity cap is limited, we'll continue to monitor its availability and just generally monitor interest rates to determine whether secondary market, bonds, or both are best execution. Does anybody have any questions on what I went over here?
No.
Okay, well, hearing none, I think that concludes my part of this reporting, Barry.
Sounds great, Tracy. Appreciate the update. Sounds like everything's moving forward, and especially in this challenging environment. Okay, so I guess we're into Brad.
All right. Well, thank you, everyone. Hopefully, can you hear me okay?
Yes.
Okay, great. I'm similar to Barry. I'm traveling for work, though, so I did pull off on the side in a parking lot, so I'm not looking at the screen while driving down the road. But just wanted to make sure you could hear me okay before we get started. So my name is Brad Shelley. I'm an audit partner at Crow, and happy to be on here with you today to talk through the audit results briefly. Tracy went through a lot of the mortgage activity, so I'll focus primarily just on the audit results and then maybe a couple of financial highlights. But then obviously if you have any questions, let me know. The one thing I did want to point out before we get too far into this, you'll see this is what we call the long form financial statements. So it includes the independent auditor's report, the management discussion analysis or MD&A, all the basic financial statements, and then also includes, in addition to the supplementary, includes the reports related to the single audit or the federal compliance audit. The OMB has not yet issued the final version of the 2025 compliance supplement. So the AICPA has strongly recommended that firms don't issue the single audit reports until the OMB actually issues this year's compliance supplement. So we have been working off a draft. We've completed all the testing, all the reviews. So everything is done. All we're waiting for is that compliance supplement to be issued. But at this point, it's looking less and less likely that it's going to be issued before September 30th. So what we will do is we will issue the what we'll call the basic financial statements, essentially the first 44 pages of this. And we'll issue that prior to September 30 so that you can file with Ginnie Mae and the others. And then once the OMB releases that final compliance supplement, we will review that and make sure there's no substantive changes to it. And if there's not, then we will go ahead and issue the single audit report as well. Of course, if there are significant changes, we'll let you know. But at this point, I don't anticipate that since they've already provided a draft of it. But just wanted to clarify that off the top. Just a little challenge we're all working through this year. So with that, we can jump into the report. These first couple pages, this is the independent auditor's report. So if you scroll up just a little bit, Sam, to the opinions. So this is where we are providing our opinions on the various funds of the financial statements of KHC. So we are providing an unmodified opinion, which means that these financial statements are free of any material misstatements. Essentially, it's a clean audit opinion, the highest level of assurance we can provide. So positive there. The rest of the part of the report is the same as previous years. It goes in to responsibilities of both parties. Our responsibility as auditors is to perform testing and audit procedures over the financial statements. Ultimately, the financial statements themselves are the responsibility of management. And so that just outlines that. If you scroll down, keep going, Sam, you can skip through the rest of the independent auditor's report. That pretty much covers everything here. Yeah, keep going.
Sorry, my computer froze for a moment.
Oh, that's okay. Perfect. So here, the management discussion analysis, or MD&A, is where we'll spend just a few minutes. I always think this is a good area to look at because it provides comparative information, also provides some analysis from management on what some of those changes are and what they include. So some of the highlights are included here by management as you look corporation-wide, and that's what I'm going to primarily focus on is the entire corporation. The net position, or essentially your equity, if you're thinking from a for-profit standpoint, increased by about $33 million. That was primarily on the business type activity side, and we'll see that in a minute. Tracy went through a lot of the loans, but highlighted here the single-family loan originations totaled $579 million. It's a good thing that matched up with what Tracy just said earlier, so that's good. As you continue scrolling through here, just some more highlights, and I'll let you read through these. But if you go to the next page, I believe maybe go one more page, sorry. So here in this table 1 is a very condensed version of your statement of net position or your balance sheet. So you could see the changes year over year. Overall, current assets increased to about 547 million for the corporation. Non-current assets, 887 million. Again, this is primarily related to all the loan activity that you have during the year. Current liabilities, 141 million. So not much change on the current side of things as those obligations become due. But obviously, as you issue more bonds, your non-current liabilities has increased up to about 773 million. So you see a lot of changes on both sides, but again, just the activities of the bonds being issued and loans being serviced. So net position is essentially your equity, and so you see an increase there from 486 million last year to about 519 million this year. If you go ahead and go to the next page. In table 2, this is the condensed version of your statement of activities or your income statement. And again, you can see the comparative and there you go, the first column, governmental activities and business type and corporation in the far right. So from a revenue standpoint, you see an increase in the revenues from 344 to about 418 million. On the expense side of things, again, correspondingly, you see an increase in expense. A lot of that is related to grant funded programs. So you see most of those are cost reimbursement grants to where you're expending dollars and then getting reimbursed through federal grants. So that's why you see a lot of the increase in revenues and expenses for similar amounts. Overall, your excess or your net income before transfers was up to about $33 million this year. And then if you scroll down just a little bit, you'll see those interfund transfers between the business type and the governmental funds, and ending is still overall corporation-wide $33 million increase. If you continue on from here, and Sam, go ahead and jump through a few pages. If you can get to the notes to the financial statements, just a few things I want to point out. So this continues on the MD&A section. So I said this is a good one to look at. There's lots of information in the MD&A. These are your basic financial statements. Again, touched on some of the highlights already. And there's several pages of these. Sorry, I could have opened it up, I guess, and told you the page number. So starting here is the notes to the financial statements. Not a lot of changes this year, but a few things to point out as you go to note B in the summary of significant accounting policies. Continue scroll down a little bit there towards the end of note B. There's a couple of new accounting standards this year, GASB 101 and GASB 102. GASB 101 is related to compensated absences and required you to look at the various types of leave that you might have, whether it's vacation, PTO, sick leave, etc. Most of the common ones. And yeah, you can stop there for just a moment, Sam. So you'll see one of these footnote disclosures has been modified a little bit. So we added a policy around compensated absences to disclose that in here to explain vacation leave, how it is accrued for, sick and personal leave, how it's accrued for. What's changed this year was that prior to GASB 101, you only accrued for leave if it was going to be paid out. If it was potentially going to be used but not paid out, oftentimes like a sick leave where that's a type of leave where you're typically not paying that out at the end, or there's vesting period, something like that, it wasn't being paid out. Under GASB 101, it clarified that and said you need to accrue for any liabilities that are more likely than not to be used for time off or paid out. And so it captured a couple of things. One was any type of leave that might be paid out that wasn't 100%, but maybe falls in that category below of it's more likely than not to be paid out. Or it also picked up leave that may be used versus being paid out. So if sick leave is, most people take some sick leave during the year. Sick leave is going to be used in the next year, but it wasn't necessarily accrued before. Now you would accrue for that estimated amount of time off that will be taken over the next year. So a little bit of a change there, that policy change there. And then same if you keep going from here, it's towards the end of this note. Yep, right there. As you'll see, the second paragraph there notes that there was about $1.2 million impact from this adjustment. So not a huge amount in the grand scheme of the dollars that you have on your balance sheet, but did increase the liability by about 1.2 million. And that was reflected in the financial statements as of the end of the year. GASB 102 was the other one that's disclosed here around certain risk disclosures. There was no impact from this. We evaluated this, discussed with management, and really this what this GASB requires is you to disclose information if you have certain types of funding concentrations, significant concentrations, or risks that may be higher level than previously disclosed. So nothing really to disclose there. There are a couple of new disclosures for or accounting statements that'll be due next year to be implemented, GASB 103 and 104 that you'll see at the bottom of this page. Similar, I don't expect any financial changes here. So unlike GASB 101, where there was a dollar impact, I don't anticipate there being any dollar impact to either of these. These are just both accounting standards that may modify some of the footnote disclosures and add potentially some disclosures, but not change the dollar amounts. So that'll be for next year. From there, if we want to jump ahead to the supplemental schedule, Sam, so several pages. Most of the rest of the footnotes, not really any significant changes. Obviously, we updated the debt schedules for new debt issuances, etc. But so as you get to the supplementary information, a few things. One, this is the same schedule that you've had in the past that just breaks down the revenue bonds fund into more detail. So combining schedule here, you can skip ahead from this one. Same thing here, just the housing revenue bonds combining schedule. Continue. Yeah, you can keep going through all these combining schedules. So this next section here starts the single audit, and this is the part that I said we'll have to pull this part out and issue this later. The first report that is here is the independent auditor's report over government auditing standards. And so this is really focused on the financial statements themselves and the schedule of expenditures of federal awards. We did not identify any material weaknesses, significant deficiencies, or compliance issues to note. So that's essentially what these here are disclosing. So if you skip ahead to the next report, the next one is in accordance with, go ahead and go to the next page. The next one's in accordance with uniform guidance, and this is specific to the major federal programs. And so we did have 3 major federal programs we'll go through in just a minute. As part of our testing, we go through analysis of all your federal programs to determine which ones are major this year, which ones maybe aren't major and don't need to be tested and will be tested in future years. So our report is just disclosing again that we did not identify any significant deficiencies, material weaknesses, or any compliance matters to note. So that covers this report. And if you continue on, Sam, to the next, I think is the schedule of expenditures of federal awards. Yep. So this is the schedule. It lists all of the federal awards. The one thing that is different with this year that you'll see is it's excluding the loan guarantee program. So for many years, I've been partner on this audit for, I think this is 4 years now, 3 or 4 years. And every year we've tried to confirm whether those mortgage guarantee programs, loan guarantee programs that run through HUD, the VA, and the USDA, we've tried to identify whether those should be included on the schedule of expenditures of federal awards or not, whether they're subject to testing or not. We were able to find one thing. There's one source that from the beginning we could find that it says it was not required. But always in discussion with management, we weren't 100% sure because the federal government has made an obligation on them, and none of the federal agencies would ever respond to our questions about it. So this year we went through the same process and inquired to all three of the federal agencies and actually did receive back, I think it was from USDA, if I remember correctly. See the USDA or VA. Responded back and confirmed that no, they do not need to be included on the CFA. You do not need to subject those to testing. We tried to reach out again to the other ones, did not get anything official back. Actually, both of them responded, but both of them said, I don't have an answer for you. So it wasn't really helpful. But since all three of those programs operate identically, but just have different eligibility requirements, between the one confirming that they shouldn't be, between the other, the federal website saying they're not subject to federal compliance testing. And then Tracy had done some research and reached out to peer agency in Alabama, and they confirmed that they have not included those on there. And when we looked at the federal data collection form filings, the vast majority of state housing corporations were not including those loan guarantee programs on there. So we and management felt comfortable with removing those from there. So it's a long-winded answer. It took us several years to get to that point, but I feel comfortable with those not needing to be on there. What it does do is it saves a little bit of testing time. Although admittedly, those were some of the easier programs to test compared to some of the other programs that we tested, for example, this year. So you won't see those on there going forward and for this year, but all the rest of the grant programs are listed here, and you can see about $310 million spent during the year. If you go to the next page, actually skip a couple of pages. This is the schedule of findings and question costs, summarizing all of the information I just mentioned. If you scroll down to the bottom, I'll just point out a couple of things here. No, go up just a little bit. Sorry, bottom of that page. Yep. So there's the three major programs that we tested. So the Housing Choice Voucher Cluster. So there's actually three grant programs that the federal government requires us to cluster those together and test as one grant. So that cluster we tested, the Homeowner Assistance Fund, the HAF program we tested, and weatherization. So those are the three for this year. Those will continue to rotate in future years. The other thing to point out is you continue to qualify as a low-risk auditee, which does help from the standpoint of reducing the amount of testing that is required and the number of programs to be tested. So if you remember, previously there was a couple years where you had went to high risk just based on one issue, and that has rolled off, and now you're a low-risk auditee. So I think that covers everything from the audit report. I know that was a quick, maybe 20-minute overview of the entire process. Takes a lot of time, certainly for us, but even more time
Aye.
All those opposed, like sign. Motion passes. So again, great job, guys.
So
Uh,
I had a quick question.
oh, yes.
And probably should have asked it before. It doesn't have anything to do with the vote. Am I wrong in assuming that been a roughly 6.5% positive net position growth in net position? Is that right, Tracy?
Yes,
If my math's right, I'm an attorney, so I know
that's
how to
probably
do
about
it,
right. Yeah.
but okay, because 33 million of 486 or whatever would seem to be 6.7 or 6.5, something like that. I would think that that's relatively high performing relative to other state programs or entities with this mission. Is that right?
Yeah, we've had a real profitable year. We've had a couple strong years here now in a row, which is, we definitely have concerns going in, but with our mortgage origination and our servicing portfolio growing, I mean, the fact that we haven't had loans prepaying plays a big role in that as well. That we're able to grow our portfolio and earn considerably more. And then some of our investments, we've got a lot of investments in Dreyfus investment accounts that are in a high rate environment, producing much more interest income compared to the interest we're paying out the door. So
It just seems pretty impressive for an organization with this mission. So good on you all.
With the mission and the environment, both are both to play both of those it's pretty impressive. Because I don't even know that the for-profits are doing that kind of doing as well as that.
Yeah. Sorry to interrupt. Just wanted to give kudos to try to figure out if I was thinking it right in my little pea brain on how the numbers were shaking out. So
Barry, this is Winston. Can you hear me?
Yes, I can.
If it's appropriate, I'd just like to say a couple of words and compliment Tracy, Matt Razor, Kevin in audit, and in terms of all the work that they've done and their team has done in cooperating with Crow to make this all this audit happen, and to say congratulations to the entire corporation for having basically a clean audit, which it happens not only on the audit, on the accounting side and the finance side, but it happens on the operations side as well, all the programs, whether they be the federal programs or the mortgage program or the, financing, the collection aspect of the corporation. So I think the entire team has done a great job here and had another good year, and the audit demonstrates that.
Absolutely. So any other thing we'd like to discuss on the audit? Hearing none, Sam or Winston, do we have any informational items that we'd like to bring before the committee?
None other that I know of, other than what I just mentioned. We look forward to, we have an executive committee meeting on Monday on a couple of items that sort of can't wait until the regular board meeting. And then we've got a board meeting coming up soon. Sam, when is the board meeting?
The board meeting is Thursday. I believe it's, sorry, my calendar is not pulling up here.
October 30th.
October 30th.
Yeah,
yes,
okay.
Thank you.
Sorry, I couldn't find my unmute. But you said that the executive meeting was Monday and it's actually Tuesday. So I just
Thanks for correcting me. Yeah, I
that's
don't want to
okay.
confuse anybody.
Good deal.
Yeah.
Well, if no other informational items, I will entertain a motion to adjourn.
So moved.
Do you have a second? Do we have a second? I didn't hear.
I'm sorry, I
Oh, okay, I'm
seconded.
sorry. Sorry. So all those in favor of leaving?
Aye.
Aye.
Great. Well, I'll just throw the gavel down on that one. Great meeting, everyone. Appreciate the audit, as we mentioned. Tracy, great job. Team, great job. I'm going to print up shirts that say Jim Who.
I appreciate everyone's support. I really do. Thank you.